Hello everyone, this is Michael's Fortune Bread, your guide to the US stock market. 2025 is set to be an exceptional year for the US stock market, with not only great potential for the overall market, but also disruptive opportunities in individual stocks. An ordinary investor might not encounter such a favorable year even after many years in the stock market. This is a great year for us ordinary people to accumulate our first pot of gold, and this opportunity is now very close to us. How to seize it will be the key to investing in US stocks in 2025. To produce this video, I spent over a month preparing, reviewing numerous investment bank reports, and consulting with several industry veterans. Finally, we have today's comprehensive outlook for US stock investments in 2025. Actually, 2025 began with a lot of skepticism. Some say that after 2 consecutive years of a bull market, US stock valuations are already very high. Can they still rise? Others say that with Trump in office engaging in trade wars and repatriating immigrants, can the US economy hold up? Some also say that the Federal Reserve has hinted that it might pause interest rate cuts. Are the good days for US stocks over? These doubts are not without reason, but after my in-depth research, I found that these are not the key factors for future US stock investments. As you might have guessed from the beginning, I am very optimistic about 2025. So what are the things truly worth our attention in 2025? What opportunities give me such confidence? And what risks must we investors be aware of? I believe that after watching this video, you will be able to start your New Year's investment journey with peace of mind. Next, I will analyze the 2025 investments from 3 most important factors: the macroeconomy, Trump, and AI. These 3 factors independently have completely different impacts on the stock market, and when combined they complement each other. There is a hidden but clear investment logic behind this. Let's analyze them separately first, and then I will give you a comprehensive view of the US stock market in 2025. In the past 3 years, what has been the core factor affecting the US stock market? Nothing else but the US macroeconomy, from inflation to recession, and the Federal Reserve's monetary policy behind it. The macro concept is changing, but it always affects the market's most sensitive nerves. For the past 3 years, I have been analyzing the market every day, and I deeply understand how deeply the macroeconomy affects US stocks. So, what role will the macroeconomy play in 2025? Will it be as important as before? From the changes in the Federal Reserve's most concerned inflation indicator, PCE, over the past 4 years, we can see that PCE has been on a steady downward trend over the past year. The latest PCE data is below market expectations and is already very close to the target of 2%. In the future, with the continued decline in rent inflation, the downward trend of PCE inflation is inevitable. From the performance of the US unemployment rate over the past year, the unemployment rate began to decline steadily after peaking at the end of the year. There was a recent small rebound, related to weather and companies' wait-and-see attitude before the election. But these are very short-term factors. It is expected that the unemployment rate will return to a steady downward trend afterward. From the performance of US retail consumption accounts for more than 70% of the US GDP, and it is the data that best reflects the current level of economic growth in the US. Currently, retail consumption has basically returned to pre-pandemic levels and is performing very stably. From the holiday consumption data released by Bank of America, we can also see that this year's consumption enthusiasm is even higher than in the past 2 years. In 2025, the macroeconomy, whether it is inflation, employment, or consumption, is showing a relatively strong state. This relative strength can be said to have limited downside risks because the risk of recession is gradually being eliminated. But it can also be said that its upward momentum is not very strong. After all, there was no deep squat in this cycle, so it is difficult to jump high. The overall economy is in such an unremarkable state, with low risk but also no great expectations. If the macroeconomy was the decisive factor in the past 3 years, then the macroeconomy in 2025 may just be an observation indicator. As long as it does not have major problems, it is unlikely to play a decisive role. So, will the Federal Reserve's monetary policy, which is closely related to macro indicators, play a decisive role? In the past 3 years, US stocks have indeed been like this, but in 2025 this factor may also gradually be diluted by the market. Why do I say this? Because after the latest Federal Reserve meeting, US stocks experienced the second most severe decline this year. It seems that the Federal Reserve still has a significant impact on the market. But after understanding the logic behind it, you will realize that this decline may be the last time the Federal Reserve causes such high panic. The reason for this market decline caused by the Federal Reserve is that Powell hinted that the Federal Reserve might not cut interest rates continuously as before in 2025. The expectation for interest rate cuts in 2025 dropped from 6 times to 2 times, making the market start to doubt whether the Federal Reserve will change its attitude and whether tighter monetary policy will impact the US performance. But in fact, before the Federal Reserve meeting, the market had already predicted on the CME that the Federal Reserve would only cut interest rates twice in 2025. The Federal Reserve's statement this time only confirmed the existing market expectations. However, Powell's statement itself is a manifestation of hawkishness, which is unavoidable. After all, the number of interest rate cuts has indeed decreased. For the market, this can only be considered a clear signal, but it has not brought any changes. The reduction in interest rate cuts has long been a consensus. There were no problems before, and there will be no problems afterward. In fact, the key issue is not the reduction in the number of interest rate cuts, but the reason for the reduction. Why do the market and the Federal Reserve both believe that there should not be so many interest rate cuts next year? If the reduction in interest rate cuts is because inflation is going to rebound, then it is indeed worth worrying about. But if the reduction in interest rate cuts is because the US economy is strong or the neutral interest rate is going to rise, then there's no need to worry. And I firmly believe it is the latter. In fact, the same thing happened in the US stock market in 1995. At that time, the Federal Reserve also raised interest rates rapidly due to inflation, raising interest rates by 300 basis points in 1 year. After inflation was gradually brought under control, the market originally expected the Federal Reserve to cut interest rates quickly and return to the previous loose level. However, the Federal Reserve at that time only symbolically cut interest rates twice by 50 basis points and never cut them again. The reason behind this was the strength of the US economy at that time. And in those years, although the US stock market continued to face relatively high interest rates, it still showed a good long-term bull market performance from 1995 to 1998. Therefore, the real core that affects the market is the profit growth brought by a booming economy, not the level of interest rates. And I believe the US stock market in 2025 will be the same. Earlier, we analyzed that the US economy is still very strong, and later we will discuss some reasons that make it even stronger. In this context, I believe that the Federal Reserve pausing interest rate cuts is actually a good thing for US stocks. The micro-manifestation of a strong economy is the continuous improvement of corporate profits, which is closely related to every listed company in the US stock market. The improvement of corporate profits is far more supportive of a healthy rising stock market than a loose monetary environment. For us investors, this means that the importance of the Federal Reserve will gradually diminish, and the market's focus will shift from whether to cut interest rates to whether corporate profits can steadily improve. Therefore, the stock price fluctuations caused by the Federal Reserve's monetary policy, in my opinion, will become rare buying opportunities for us investors. At this point, some viewers may question whether the repeated inflation is really not worth worrying about. Indeed, the Federal Reserve also mentioned the threat of repeated inflation at the meeting, and this threat mainly comes from the new President, Trump. We will talk about this threat from Trump later. Overall, looking at the macroeconomy and the Federal Reserve's monetary policy in 2025, we can draw a clear conclusion that US stocks are moving out of the main investment logic of the past 3 years. In the future, the role of both the macroeconomy and the Federal Reserve will gradually diminish. If you cannot break away from the inertia of previous thinking, you will inevitably stumble in your investments in 2025. Regular market watchers should still remember that in 2022 and 2023, the market fluctuated violently almost every time economic data was released, or the Federal Reserve held a meeting, sometimes plummeting and sometimes soaring. However, in the past 6 months, except for the recent Federal Reserve meeting that changed the landscape, the market has not fluctuated much due to macro events. So this trend has actually been evident for a long time, but many investors have not realized it yet. I believe this situation will continue in 2025. For us ordinary investors, this means that on the one hand, we can invest in US stocks more confidently without worrying too much about the potential pullback caused by macro risks. We just said that the macroeconomy and the Federal Reserve will take a backseat in 2025. So who will take the stage? It is Trump. In fact, looking at the history of US stocks, the impact of the president on US stocks is almost negligible. However, Trump is not an ordinary president. During his previous term, Trump brought significant structural changes to US stocks. And the same thing is likely to happen again in US stocks this time. We investors must be prepared in advance. Looking at the major events and the performance of US stocks during Trump's previous 4-year term, almost every major event caused more or less fluctuations in US stocks, showing the importance of Trump as a variable for US stock investments. Today, we will not talk about history, but discuss the specific impact of Trump's policies on the stock market in 2025. The 3 most important policies of Trump that affect US stocks are tariffs, tax cuts, and deregulation. Other policies, such as immigration, have limited impact on the stock market. Let's first look at tariffs, which are likely to be one of the first policies to be implemented in 2025. In a democratic system like the United States, most policies need to be approved by Congress to be implemented, such as tax cuts, so their implementation may not be quick, and there will be a lot of tug of war in between. However, there is one exception, which is policies related to national security or foreign affairs, which the president can decide directly without going through Congress. This means that as long as Trump wants to implement his tariff policy, he can do it at any time. The most intense tariff policy during Trump's previous term was the trade war with China. Looking at the performance of the US stock market during the last US-China trade war, we can see that the US stock market fluctuated greatly throughout the process. Although these fluctuations cannot be entirely attributed to the trade war, The shadow of the trade war was present in every instance. Any audience who invested in US stocks during those 2 years should understand that holding stocks during this period required a very strong mindset. This time, Trump's tariff policy is even more intense than the last time, with higher tariff increases and a wider range. Therefore, we have reason to believe that the high volatility of the market, as seen before, is likely to happen again. For us ordinary investors, this means that on the one hand, we must always be prepared to deal with risks, and on the other hand, if you have a global perspective, you will find that every fluctuation caused by the trade war is actually a good opportunity to buy the dip. Looking closely at the US stock market in 2018 and 2019, the pullbacks caused by the trade war showed a typical V-shaped pattern, with sharp declines followed by strong rebounds. This is a very good buy the dip opportunity. After all, no matter how scary the trade war is, it is ultimately a short-term risk. The market always believes that any differences will be resolved through negotiations. Therefore, while controlling risks, investors should not forget to seize opportunities. In addition to bringing greater volatility to the stock market, the trade war will also pose a threat to inflation. This is also the main reason we mentioned earlier, that the Federal Reserve is more cautious about cutting interest rates. Theoretically, higher tariffs will indeed increase the prices of imported goods, thereby bringing a higher threat of inflation. So, how much of a threat will tariffs pose? According to the London Stock Exchange's estimate of the impact of tariffs on inflation, if tariffs on China are increased by 60% and tariffs on other countries are increased by 5%, US inflation in 2025 will remain stable, with only a 0.3% increase. And by 2026, inflation will increase by up to 1%. However, I personally believe that the ultimate threat will not be this high. It should be noted that Trump's purpose in imposing tariffs is not really to collect that tax, but to use tariffs as a bargaining chip to seek a better trade surplus. As a businessman, Trump understands the bargaining chips and risks of trade negotiations. The current market expectation is to treat Trump as a stubborn and reckless person, but the actual situation will certainly not be like this. Trump's tariff policy is also flexible. If he sees signs of inflation, I don't think he will insist on implementing the tariff policy, as the harm of inflation is obviously greater. Let's return to the previous issue with the Federal Reserve. I believe that the threat of inflation will ultimately not be the main reason for the Federal Reserve to pause interest rate cuts. There is uncertainty, and the Federal Reserve needs to consider it, but in the end, I believe it will not become a real threat. Another important policy of Trump is tax cuts. The impact of tax cuts is more direct. From the performance of government corporate tax revenue during the last Trump tax cut period, we can see that after the tax cuts took effect in 2018, the effect was immediate, with annual tax reductions of about $100 billion, which directly reflected in the profits of American companies. However, as mentioned earlier, it is difficult for the tax cut policy to be implemented in the short term. Before it is implemented, it will have a certain positive impact on the market. From the performance of the US stock market from Trump's election to the actual implementation of the tax cut policy, we can see that even if the tax cut is not fully implemented, its positive impact will be felt in the stock market in advance. The last policy of Trump that has a profound impact on the stock market is deregulation. This may be the most underestimated policy benefit at present. At the end of 2017, Morgan Stanley summarized the performance of the US stock market for the year, saying, It's all about deregulation. This means that the unprecedented bull market in the US stock market in 2017 was entirely supported by deregulation. I believe that deregulation in 2025 will also play a crucial role. Many people do not understand the role of deregulation, thinking it only brings some emotional speculation. In fact, deregulation allows companies to truly let go and do things, dare to take risks, and pursue innovation. This may involve adding new businesses, acquiring new companies, or making bold internal restructuring or reforms. All these changes are structural and sustainable, not only immediately improving profits, but also having a very profound long-term impact. Don't be fooled by the fact that many companies' stock prices have already started to rise due to the expectation of deregulation. In fact, these increases are likely to continue for a longer time because Wall Street cannot quantify the specific impact of deregulation. It may become the most surprising upward force in 2025. For example, in 2017, the entire financial sector continued to grow throughout the year, increasing by 50% in 1 year. So, if Trump's tax cuts are a one-time benefit, deregulation is actually a stronger and more sustainable upward momentum. Among all sectors of the US stock market, the sectors most benefiting from deregulation include finance, industry, and healthcare, which are traditionally the most heavily regulated sectors. In addition, AI is also a heavily regulated area, and Trump's deregulation may greatly promote the development of the AI industry. Currently, technology, finance, healthcare, and industry already account for 64% of the US stock market's weight. Therefore, if their overall profitability improves under deregulation, the impact on the US stock market will also be very profound. Another area deeply affected by regulation is digital currency. Trump's deregulation will be a disruptive change for this industry. Overall, Trump's 2025 policies of deregulation and tax cuts will become two continuous driving forces for the rise of US stocks. Deregulation will continue to drive the improvement of corporate profits, while tax cuts will be like a big pie hanging in the sky, constantly stimulating investors' optimism. Tariffs, on the other hand, will bring more short-term fluctuations to US stocks, increasing the difficulty of investing in US stocks. However, under the premise of controllable inflation threats, it will not change the overall upward trend of US stocks. If we look at the macroeconomy and Trump's policies together, we can also find a clear logic. Trump's policies will overshadow the Federal Reserve and the macroeconomy, becoming the key to determining the trend of US stocks in 2025. When we say that the macroeconomy will gradually take a back seat in 2025, it does not mean that it is no longer important, but that the possibility of unexpected events is relatively low, with limited upside and downside risks. The real variable that determines the trend of US stocks is in Trump's hands. We know that Trump's policies inherently have greater uncertainty, so it is difficult for the market to truly quantify their impact. However, from historical experience, the probability of Trump's policies bringing surprises is very high. His three key policies are likely to become the key to determining the market trend in 2025. The specific direction, as mentioned above, is to bring greater fluctuations in the overall upward promotion. Now, with a global perspective, you will find that no matter how important Trump's policies are, they are just an ordinary benefit for US stock investments. They can help you make money, but they cannot make you rich. If you want to accumulate your first pot of gold in 2025 and truly achieve a qualitative change in investment, then you must understand this third important concept. AI. In 2025, AI will no longer be an exclusive benefit for a few companies, but will become a broader opportunity. In 2025, AI will no longer be just a speculative concept, but will bring real performance improvements. In 2025, AI will no longer develop step by step, but is likely to usher in a critical starting point for the entire industry. Therefore, understanding the investment opportunities brought by AI in 2025 will be the key of keys. Since this video is too long, I will broadcast this part of the content next week. Happy New Year to everyone. If you like my video, don't forget to like, follow, and share. Thank you all.